Welcome to the deep dive. If you've ever looked at global financial markets and felt, well, a bit overwhelmed, like you're staring into this giant interconnected machine with a million moving parts.
It happens, it's complex, it's fast-moving.
Exactly. And it can feel impossible to make sense of. But what if there was a shortcut? A way to understand the essential currents moving money around the world right now?
That would be helpful.
Well, that's our mission today. We're taking a deep dive into an exclusive snapshot, really, of the global intermarket landscape for August 2025.
And we've got quite a bit of analysis to sift through, everything from central bank moves to what's happening in crypto.
Right. Our goal here is to pull out the most important nuggets of knowledge, the key insights. We want to help you understand the primary drivers, see how different assets are performing, and really critically, how they all influence each other.
It's like peeling back the layers, seeing those hidden connections.
Exactly. We're going to explore this fascinating tension between central banks trying to ease policy while at the same time battling persistent inflation.
And the puzzle of slowing global growth alongside surprising U.S. resilience.
Plus, of course, that ever-present shadow of geopolitical risk. So, yeah, get ready for some genuine aha moments. We're about to connect some serious dots.
Sounds good. Where do we start?
Okay, let's unpack this. Before we zoom into specific markets, we really need to understand the big, overarching forces at play globally. These are the engines driving everything else.
The macro drivers.
Precisely. And right at the top of that list, we've got these divergent central bank easing cycles. What's going on there?
Well, what's really crucial to grasp here is that August 2025 marks a global pivot, a shift towards monetary easing. But, and this is key, it's not synchronized. Not at all.
So everyone's moving, but at different speeds.
Exactly. Each central bank has its own pace, its own magnitude. Take the U.S. Federal Reserve, for instance. They've adopted what the analysis calls a distinctly dovish tone.
Dovish meaning leaning towards easier money, lower rates.
Correct. Markets are now pricing in a high probability of a rate cut in the fourth quarter. This is driven by a noticeable cooling in the labor market and, frankly, growing concerns that the current restrictive policy might tip the economy into a recession.
So the Fed, after all that aggressive tightening, is basically signaling, okay, maybe time to ease off the brakes.
That's the message the market is receiving, yes. But like you said, this isn't just an American story.
Right, who else is involved?
The Bank of England has already started cutting rates. And the European Central Bank, the ECB, is widely expected to follow suit pretty soon.
Okay, so a collective move towards easing. What does that generally mean for assets?
Generally, it supports asset prices. Lower rates make borrowing cheaper, potentially boosting investment and consumption. However...
There's always a however.
Yes. Because of these differences in timing and the expected size of the cuts, we're seeing notable currency fluctuations as a real dynamic interplay.
That makes sense. If the U.S. is expected to cut later or less than, say, the U.K., the dollar might hold up better relative to the pound, for a while at least.
Precisely. It creates winners and losers in the forex market based on those expectations.
Okay. But speaking complications, we also have this thorny issue of tariffs causing inflation problems. That makes the central bank's job even harder, doesn't it?
Indeed. This is a significant wrench in the works. The recent expansion of U.S. tariffs, plus just broader global trade tensions, it's creating classic cost-push inflation.
Meaning costs for businesses are going up and they pass that on.
Exactly. And what that means for you, the consumer, the investor, is that both headline inflation and that core figure, which strips out food and energy, are proving stickier than central banks would like.
Stickier meaning harder to bring down.
Correct. And this puts policymakers in a really tough spot, a genuine dilemma. Do they cut rates to support growth, even if it risks inflation staying high?
Or do they keep rates higher to fight that sticky inflation but risk causing a recession?
That's the tightrope they're walking. And that tension right there is a primary source of market volatility. Investors are constantly trying to guess which way they'll lean.
Sounds like navigating between a rock and a hard place. And against that backdrop, we're seeing this broader trend of slowing global growth. But the U.S. seems to be holding up better. How does that work?
Yeah, the core idea is a global economy that's slowing down, decelerating, but not exactly falling off a cliff. It's gradual.
Okay.
We see clear signs of strain in places like Europe and Japan. They're grappling with higher energy costs, slowing exports, that kind of thing.
With the U.S.?
The U.S. has been remarkably more resilient, although even here you look at forward indicators, things like the PMI, the Purchasing Managers Index.
Which tells you about business conditions.
Right. That and slowing private consumption suggests that momentum is starting to wane, even in the U.S.
So the market's base case, the general hope, is for a soft landing in the U.S. Inflation cools, no deep recession.
That's the consensus view, yes. But the risk, well, the risk of a policy error, maybe the Fed misjudges things, cuts too late or too much.
Or an external shock.
Exactly. An external shock remains elevated. We're talking, an unforeseen event, maybe a sudden energy price spike, some kind of financial contagion we didn't see coming, something that could quickly shift the narrative towards a real recession.
It's definitely a source of anxiety.
It keeps strategists up at night, that's for sure.
And as if all that wasn't enough, we still have the elephant in the room. Geopolitical risk, it just feels like this constant hum in the background noise.
Absolutely. Ongoing conflicts, those simmering U.S.-China tensions, they create this persistent layer of uncertainty. And it's not just headlines.
It affects markets directly.
Oh, definitely. It supports demand for traditional safe haven assets, think gold or sometimes the U.S. dollar. And critically, it can cause these sudden spikes in volatility, maybe in commodity prices too. It acts as what we call a constant tail risk.
A low probability but high impact potential event.
Exactly. Something that's always lurking in the background.
Okay, so those are the big macro forces shaping the environment. Powerful stuff. What does it all mean for different parts of the market? Let's dive into how these factors are playing out in specific asset classes and, crucially, how they're all talking to each other. Where should we start? Maybe stocks.
Good place to start. Global equities, what's striking right now is they seem to be in a consolidation phase. They had a strong recovery earlier in the year. Now they're sort of pausing.
And the U.S. still leading the pack.
U.S. markets, particularly the big, large-cap tech companies, are still showing impressive outperformance. But, and here's where you need to dig deeper, valuations look stretched.
Meaning stock prices are high relative to earnings.
Yes. The S&P 500's forward price-to-earnings ratio is well above its historical average, and perhaps more concerning, market breadth is a concern.
What does breadth mean in this context?
It means the market leadership is heavily concentrated in just a few mega-cap names. So the overall market might look strong, but it's being propped up by just a handful of stocks.
Which makes a whole market vulnerable if those few giants stumble.
Precisely. It's a risk that can get overlooked if you just look at the headline index number. The trend overall is, let's say, cautiously bullish, but highly sensitive.
Sensitive to what? How do stocks connect back to those macro drivers we discussed?
Well, there's generally a strong negative correlation with bond yields. Stocks tend to rally on news that hints at lower rates, like weak jobs data, and they get nervous about inflation.
So that sticky tariff-driven inflation is bad news for stocks.
It's a real headwind, yeah. It pressures corporate margins, hits earnings, and the U.S. dollar plays a role too. A stronger dollar is usually a headwind for U.S. multinationals' earnings.
Because their overseas profits are worth less in dollars.
Right. Conversely, the recent softening we've seen in the dollar index, the DXY, that's provided a bit of a tailwind.
And there's that fascinating divergence happening too, isn't there? The stock market seems pretty resilient, even though the yield curve was inverted for so long, which historically signals recession and only recently uninverted.
It absolutely stands out. Equity investors are clearly making a bet. They're betting on that soft landing and that the Fed will step in with easing quickly enough to avoid a major downturn.
They're looking past the historical signal.
They are convinced this time might be different because of the expected policy response. It's the market trying to look around the corner, essentially.
Okay, let's shift focus to bonds. U.S. Treasuries specifically. They're often the first place we see the Fed's influence, right? What's their current state?
U.S. Treasury yields are still, elevated compared to a couple of years ago, but they have pulled back from their recent highs. That's primarily on those expectations of Fed rate cuts.
So yields are down from the peak.
Correct. The 10-year yield seems range-bound for now, caught in that tug-of-war we talked about. Sticky inflation versus signs of slowing growth.
And the yield curve itself, you mentioned it, uninverted.
It remains very flat. The spread between the 10-year and 2-year yield recently uninverted, which some see as a hopeful sign. But the risk of it reinverting, flipping back, is still there. So recession concerns haven't vanished entirely.
How's the market positioned? Bullish? Bearish?
Decidedly bearish. On the short end of the curve, everyone expects cuts, which pushes short-term yields down, prices up, more neutral on the long end.
So if the Fed is the main driver, how else do bonds connect into this whole complex picture?
Well, the entire Treasury complex is fundamentally driven by the Fed's policy path. Bond prices move inversely to interest rates. That's the core relationship.
And inflation.
Higher than expected inflation is definitely bearish for bonds. It eats away at the real value of their fixed payments, and it limits how much the Fed can ease.
And what about risk sentiment?
Treasuries are a primary risk-off asset. So during times of market stress or geopolitical turmoil, money flows into the safety of U.S. government bonds. That pushes prices up and yields down.
Which is why they often move opposite to stocks.
Exactly. That negative correlation to stocks and also often to industrial commodities, which signal economic strength, is a key characteristic.
Okay, let's talk commodities. They often give us a real-time pulse on global demand. What are we seeing there? Is it a uniform picture?
No, actually, quite divergent performance across the commodity complex right now. Very different stories playing out.
Such as?
Well, gold, for instance, is in a strong uptrend. It's benefiting from a couple of things, acting as that hedge against geopolitical risk and also as a beneficiary of expected lower real interest rates.
Okay, gold is strong. What about industrial metals?
Industrial metals, think copper, things like that, they're weakening. That reflects those growing concerns about slowing global manufacturing, slowing demand worldwide.
And oil. Always a big one.
Oil prices are pretty much range-bound. They're caught between OPEC plus trying to manage supply on one side and those fears of a global growth slowdown hitting demand on the other.
So a real split personality in commodities. How do they tie into the other asset classes we've discussed? The dollar, rates.
Generally, there's a strong inverse relationship with the U.S. dollar index, the DXY. Because commodities are priced in dollars, a weaker dollar usually makes them cheaper for foreign buyers, boosting demand.
And interest rates.
Interest rates matter too. Higher rates increase the opportunity cost of holding assets that don't pay interest, like gold or oil. So lower rates are typically a significant tailwind for precious metals, especially.
And the inflation link.
Of course, commodities are often seen as an inflation hedge. Gold, in particular, tends to do well when real yields, that's interest rates adjusted for inflation, are falling.
Moving on to currencies then. We keep mentioning the U.S. dollar, the DXY. What's its current trajectory?
The DXY is currently in a mild downtrend. This follows a period where it was quite strong. The main pressure now is coming from the Fed's dovish pivot and those rate cut expectations building.
So rate cuts are generally bad for the dollar.
Generally, yes, because they reduce the yield advantage the dollar might have over other currencies. However, its status as the world's main reserve currency and that safe haven quality.
Right, it provides a floor.
Exactly. It provides a significant floor of support during periods of global market stress. So yes, it's weakening on rate expectations, but don't count it out if fear really spikes in the markets.
That dual nature is really key, isn't it? Weakening on rate outlooks, but strengthening in a crisis. How does it interact more broadly?
Well, its value is highly positively correlated with U.S. interest rate differentials. As expectations for U.S. cuts grow faster than elsewhere, that differential shrinks and the dollar tends to weaken.
Right, risk sentiment.
It has that fascinating split personality. It can weaken in a risk-on environment when investors feel confident and chase higher yields elsewhere. But it strengthens significantly during risk-off panics because everyone rushes for safety and liquidity, which the dollar provides.
And its relationship with commodities and stocks.
Generally negatively correlated with commodity prices, as we discussed, and often negatively correlated with international and emerging market stocks, too, because a strong dollar tends to tighten global financial conditions, making it harder for others to borrow in dollars.
Okay, next up, maybe something a bit different. Cryptocurrencies. Bitcoin, Ethereum. It might not seem immediately obvious, but how do they fit into this macro picture?
It's a great question, and the connections are actually getting stronger. Right now, cryptocurrencies are in what the analysis calls a strong, sustained bull market. We've seen new highs for Bitcoin and Ethereum.
What's driving that?
It seems to be a confluence of factors. Increased institutional adoption is a big one, especially with some recent regulatory clarity, like around ETFs. And then there's that favorable macroeconomic backdrop.
Meaning the prospect of lower interest rates from the Fed.
Exactly. That's a major factor. Volatility is still high, of course. It's crypto. But the trend is clearly bullish.
So are cryptos still just moving in line with tech stocks, like a high beta version of the NASDAQ? Or is something else going on?
Well, they are highly negatively correlated with real interest rates. Lower real rates, more liquidity from the Fed, that's a major catalyst for crypto.
Makes sense.
And yes, they're often seen as the ultimate risk-on asset. They show a strong positive correlation with speculative growth stocks, like those in the NASDAQ. They tend to sell off and sell off sharply during periods of market fear.
And the dollar link?
Often a negative correlation there, too. A weaker dollar can increase the appeal of alternative stores of value, which some people see crypto as being.
But you mentioned something about decoupling. They're not always just following tech now.
Precisely. That's a fascinating development.
Oh,
Cryptocurrencies seem to be increasingly decoupling from a purely one-to-one correlation with tech stocks. Sometimes they seem to act as a leading indicator for overall risk appetite, or they react strongly to their own sector-specific news.
like ETF approvals or protocol upgrades.
Exactly. It suggests the market is maturing, developing its own distinct identity, perhaps.
Very interesting. Okay, finally, let's turn our attention closer to home for many people. Real estate, specifically in the U.S. What's the picture there?
The U.S. real estate market is definitely in a cooling phase. There's no doubt about that. High mortgage rates still hovering in the mid to high 6% range, maybe even higher sometimes.
Ouch. That hits affordability hard.
Severely. It impacts affordability across the board. As a result, price appreciation has decelerated sharply. In some places, prices might even be falling slightly, and we're seeing housing inventory beginning to rise.
So shifting away from that crazy seller's market we saw.
Definitely. We're seeing a clear transition towards a more balanced market, or even tipping into a buyer's market in some regions.
And what's driving this? Is it just interest rates, or is the broader economy playing a part?
Interest rates are really the single most powerful driver here.
Yeah.
The housing market has this direct, potent, inverse relationship with interest rates. Mortgage rates are closely tied to the 10-year Treasury yield.
So Fed policy is key.
It's the single most important driver for the housing sector, yes. Because of that link, U.S. real estate is positively correlated with bond prices.
Meaning if bond prices go up,
which means yields go down.
then mortgage rates might eventually follow, helping housing.
Exactly. An expected rally in bonds leading to lower yields would be the most significant bullish catalyst for housing right now. Of course, the economy matters too, a strong labor market, wage growth, that's supportive. But slowdown or recession concerns, that's a major bearish factor for housing demand.
Wow, okay, that's a lot of ground covered across different assets. So how do all these individual pieces fit together? Can we get an overall sense of market sentiment from this? And what are the absolute strongest connections in this really complex web?
Yeah, let's try and synthesize that. If we look across the board for August 2025, based on this analysis, the sentiment for bonds is actually moderately bullish.
Bullish on bonds because of the Fed.
Exactly. That anticipated Fed pivot towards cutting rates is a powerful catalyst. It suggests yields might have already peaked, meaning prices could rise.
Okay. What about crypto? You said it was bullish.
Strongly bullish, actually. The analysis rates it a 5 out of 5. It's seen as benefiting from a perfect storm. You've got the dovish Fed, increasing institutional adoption, and strong price momentum.
All right. Bonds bullish, crypto strongly bullish. What about traditional markets like stocks and the dollar?
Stocks are rated neutral or mixed, a 3 out of 5. You've got the tailwind from the dovish Fed supporting valuations,
Yeah.
but it's balanced out by those stretched valuations we talked about, plus the potential impact of tariffs on corporate profits, so bit of a tug-of-war there.
And the U.S. dollar, DXY.
Moderately bearish, a 2 out of 5. The reasoning is straightforward. The Fed is poised to cut rates, which erodes the dollar's interest rate advantage compared to other major currencies.
Got it. And how about real estate and commodities?
Real estate also comes in moderately bearish, another 2 out of 5. Affordability is just so constrained by current rates, and it seems unlikely rates will fall far enough, fast enough, to really reignite strong demand soon.
And finally, commodities.
Neutral or mixed, like stocks, a 3 out of 5. And that reflects the split personality we discussed. It's really bifurcated.
Gold bullish, industrials not so much.
Exactly. Gold remains bullish. It's a hedge. It likes lower real rates. But industrial and agricultural commodities face bearish pressures from that picture of slowing global growth.
Okay, that gives us a sentiment snapshot. Now, what about those underlying connections? What are the most powerful influences pulling the strings here?
Well, when we talk about the most potent intermarket relationships right now, two really stand out. First, that Fed Global Central Bank dovish pivot. Its influence is massive, rated 5.0 strength.
Affecting almost everything.
Pretty much. It directly pressures bond yields down, which supports bond prices. It's highly bullish for cryptocurrencies, providing that liquidity boost. It offers valuation support to stocks, even with other headwinds. And it puts significant bearish pressure on the U.S. dollar. Even real estate feels some indirect relief from lower yields, though the affordability issue dominates.
Okay, the Fed pivot is huge. What's the second major influence?
That inflation picture specifically, the sticky, tariff-driven kind, that's rated a 4.0 influence strength.
And how does that weave through the system?
Well, it's a significant headwind for bonds, right? It limits how much or how fast the Fed can ease. It also puts direct margin pressure on stocks, potentially hurting profit.
But good for some commodities.
On the flip side, yes, it acts as a bullish driver for certain commodities, especially gold, as investors look for ways to hedge against that inflation.
It's fascinating how one factor, like slowing growth, can be bad for stocks, but good for bonds.
Exactly. Decelerating economic growth is a clear earnings headwind for stocks, and it's bearish for industrial commodities that rely on demand. But that same slowing growth becomes a bullish driver for bonds because they attract those safe haven bids when investors get nervous about the economy.
And the softening U.S. dollar, that helps some areas too.
Yes, a softening dollar generally provides a bullish tailwind for commodities, makes them cheaper. It also helps U.S. multinationals' earnings, supports emerging market stocks, and is usually seen as positive for cryptocurrencies too.
So what a journey through these global markets. We've seen this landscape defined by central banks trying to engineer a soft landing, easing policy while still fighting this persistent tariff-fueled inflation.
And a global economy that's definitely slowing down, but with the U.S., for now, showing surprising pockets of resilience. It's a complex mix.
I think the biggest takeaway here for you listening is just how interconnected these markets truly are.
Yeah,
They are not isolated islands.
not at all.
Every subtle shift in interest rate expectations, every new tariff announcement, every geopolitical tremor, it sends ripples, sometimes waves, across the entire financial system.
That's the key insight.
Understanding these interconnections isn't just, academic. It's like having a secret decoder ring when you read financial news. It helps you see beyond the headlines to the deeper forces at play,
It lets you understand the why behind the what.
and hopefully anticipate movements rather than just reacting after the fact.
Indeed. It's really about appreciating the symphony, maybe, of these relationships. Knowing, for instance, that a dovish Fed pivot is generally a major tailwind for crypto and bonds, but at the same time creates headwinds for the U.S. dollar. That allows you to think more strategically.
Gives you a much more comprehensive, proactive view of the market. Helps you spot potential opportunities and maybe risks before they become obvious.
Definitely. It's about connecting those dots yourself.
So let me leave you with a provocative thought to mull over. Consider this. Let's say the central banks actually pull it off. They navigate this soft landing successfully, which would be a huge achievement.
A big if, but possible.
Right. But then let's say geopolitical tensions suddenly escalate way beyond what anyone currently expects. Maybe a new conflict flares up. Maybe trade wars intensify dramatically.
An unforeseen shock.
Exactly. What new, perhaps previously unseen, intermarket connections might suddenly emerge? How could that dramatically shift the current bullish outlook for some of these assets like crypto or even bonds if suddenly risk aversion spikes massively in a new way?
That's a great question. It highlights how dynamic these relationships are.
It's just a powerful reminder, isn't it? The only real constant in these markets is change. And the pursuit of understanding those ever-shifting connections, well, that's never ending.